one of the bands that we have. Okay, thank you. And we have launched in the United Kingdom as a fintech solution. It has 25 different integration providers, starting with banking rails, account holding, brokerage, KYC, KYB processes, etc. So everything that we're going to talk today comes from experience, and definitely it's dialogue. So you will have a possibility to ask the questions, and if something is not covered, I will be glad to answer your questions at the end of the meeting. Okay, so throughout history, the transfer of financial information has required that a trusted third party verifies the claims made by individuals involved in those transactions. This had led to a complex system of contract verification using lawyers and other third-party systems, some organizations to confirm that payment is non-fraudulent and participants of that transactions are non-frauds. Similarly, government regulatory bodies were established to confirm the identities of individuals and the validity of legal contracts. The reason that those systems are centralized and someone need to overview them created an issue of informational sharing if you would like to create a decentralized issue, right? And that problem can be illustrated by a philosophical thought experiment, the Byzantine generals problem. And I think it's this one, yeah. So this thought experiment introduced the concept of an army that surrounds a city, like enemy camp on this slide, with 4 generals. Each general in a command of their respective divisions must anonymously agree to either attack the city walls or these camp walls or retreat from battle. Should one of them disagree with the others or refuse to make a decision, the entire army will be defeated because you need 4 armies to defeat this enemy camp. However, in this situation, the other generals cannot be certain of their peers' thoughts on the trustworthiness of the messengers communicating between the 4. Due to this, consensus is ultimately rendered impossible to attain, which renders the attack likely to fail. And that's the classical consensus problem in any kind of decentralized network. So it's very basic understanding of decentralized network in general. So what is the solution here? All 4 generals, all members of the network needs to get to consensus. And consensus in the context of distributed systems refers to the process of achieving agreement along multiple participants or nodes in a network, talking technically, on a specific piece of information, transaction, or state of the system. So in previous case, we talked about the decision attack or not attack the camp. That was a decision that needs to be shared. So it's the state that needs to be shared by the network. The goal of consensus is to ensure that all participants in the network reach a common understanding and agreement, even in the presence of potential faults, failures, and malicious actors. They need to act as a single mechanism. So consensus mechanisms play a critical role in scenarios where multiple participants need to agree on shared truths despite challenges, such as unreliable communication, faulty nodes, etc. So how is it working? The development of blockchain technology has changed the security associated with the network's ability to share and operate securely. This is done by distributing the information through a network, which members then cooperate to verify the data. So blockchain technology itself is a digital infrastructure that serves as a foundation for various network applications. So the computer code that forms the basis of blockchain create a secure and transparent way to track the ownership and transaction of the data that makes sure that all members knows who is sharing the information, but this process is still anonymous. So you don't know exactly who is the person who has shared this information, but you know that it's constantly the same person or the same node. Each transaction is recorded as a block and linked to the transaction forming a chain. So you always know what has happened. So there's some kind of history. You can change the history. You just know that something happened in there. So the chain is open to all its members who can view transactions. So you cannot hide anything in this network. That's why it's so transparent and so secure in its openness. Go next. So talking about difference between blockchain and distributed ledger system, blockchain itself is a specific type of a distributed ledger technology. It's like, as we have already discussed, it's a linear chain of blocks where each block contains a set of transactions or data that we are sharing via the network. Those data can be like literally anything, everything what you'd like to share, but it needs to be wrapped in a special way. Those blocks are linked together using cryptographic hashes, forming an immutable ontological chain. And consensus mechanisms that we have discussed in there contains proof of work and proof of stake mechanics, like which ensure agreement of the state of the blockchain. So yeah, like the most how to say that the most popular examples of blockchain usages are cryptocurrencies like Bitcoin, but it can be applied to like various sectors beyond finance. We will talk about that a bit later. Regarding distributed ledger, what is the difference is distributed ledger is a technology, not a specific implementation, but a technology itself, a concept which like including different implementations. So it refers to a decentralized system where multiple participants maintain copies of the ledger and work together to achieve consensus. So we have several nodes on the system which work together and talking each to other to understand the real state of things. Distributed ledgers can use different consensus mechanisms, so there's a communication way can be different, but it's not limited to the proof of work. So you don't need to execute like complex mathematical or cryptographic algorithms to spend a lot of power in order to get consensus to the network. While blockchains are structured as a chain of blocks, so it's linear, it's always has all the chain. Distributed ledgers can have different structures, so it can be built on graphs and it can be built on tables. So you're much more flexible in here from data perspective. And distributed ledgers find applications in like different kind of businesses. So it's supply chain management, healthcare, identity verification, more, and like a lot beyond the scope of cryptocurrencies itself. So what is a block? Block is a bundle of transaction data. So it's almost everything, anything that you would like to put into the system, you can put it into the block itself. Yeah, most closely it's associated with Bitcoin. Like for most people, you know, like blocks is a part of Bitcoin network, and blockchain structure connects blocks such that each block includes the hash value of the previous block. So you always know who is the previous in the network, and this way it is protected from the fraud. Miners create new blocks by validating transactions through a proof of work exercise. So the proof of work exercise allows anyone without permission to create valid blocks if they can expand their private computing power, so they can calculate hashes, so they can produce those proof of works. And this resource-intensive process also creates a financial barrier to deter malicious actors from aiding fraudulent blocks. Yeah, this is pros and at the same time a cons of blockchain proof of work, blockchain consensus mechanism. So let's talk a bit about blockchain transactions. How blockchain transactions work. transactions is proposed by two parties. Let's say so we have two parties, two people who would like to make some kind of transaction. After that, miners verify the transaction by ensuring that the party's account can complete the transaction. So they're verifying their identities, basically. They don't know they in person, but they're verifying their identities. And miners complete a complex mathematical puzzle to add a new block to the chain. So miners are crucial in this kind of like ledgers, this kind of networks, because they are doing the work that is wrapping up the data inside of the network. And the solution to the puzzle requires a lot of computational power, and it's producing that wrap up of the block. And the hash function, so the wrapping up mechanism around the block, confirms the authenticity of the transaction, and that's how consensus mechanism of blockchain works. So we have miners who are working for us to make sure that all transactions in the network are secure. But we have another way to implement secure transactions based on distributed ledger technology. So in trusted private distributed ledger networks, proof of work and global broadcast of transactions are not necessary. It doesn't make sense to group unrelated transactions into blocks that are then shared with many unrelated parties. Those private blockchain systems that use blocks most likely use Bitcoin structure without considering why Bitcoin works the way it does, because like there are a lot of implementations of private distributed ledger networks that are using the similar system, but they don't understand why they are doing that. So why we don't need blocks really in distributed ledger networks if we are owners of the network, and this is a private network for our product that we are creating. Because we'd like to implement simplicity and efficiency in some distributed ledger setups, especially with a small number of participants or specific use cases. The complexity of organizing data into blocks and maintaining a chain can be not necessary. If you are managing the network, we don't want to overcomplex the data structure. Consensus mechanism in our own system can be much easier. And it can be based on a central authority, which can say, okay, this is a fraudulent transaction, this is a real transaction, and we don't require the sequential arrangement of data in blocks in this way. Scalability. If we are using blockchain cryptographic method of wrapping up the data and using the block structure blockchain, it can hinder scalability due to its sequential nature within the blocks. Different data structures or approaches might be better suited to handling large amounts of data or high transactional throughput, or we can be dealing with graph-only data which cannot be built in blocks itself. And flexibility, because certain distributed ledgers might choose to prioritize flexibility over the rigid structure of blocks. They may want to adapt and modify the data structure more freely as the technology evolves. So what is distributed ledger technology? It's basically a record of consensus with a cryptographic audit trail, which is maintained and validated by several separate nodes. So we still have several separate nodes that are validating data in the network, but we can have or do not have a central authority who's responsible for having like golden copy of the data to validate the data accurate. This cryptographically assured and synchronized data can be split across multiple institutions or multiple locations in the world. Actors in this network typically employ distributed ledgers when they need a tool which permits the concurrent editing of shared state while maintaining its unicity. So if you are using like Google Docs and a lot of people at the same time are writing something in the Google Doc, it can be implemented based on distributed ledger, and several people can edit even the same word and the state would be presumed and displayed correctly. What are use cases of blockchain? So blockchain has diverse applications across industries. It can revolutionize supply chain management, ensuring transparency and authenticity of products by tracking their journey from origin to customers. In digital identity verification, it enhances security by giving individuals control over their data. Smart contracts automate agreements, simplifying processes in real estate, insurance, and more. In healthcare, patient records can be securely stored and shared among authorized parties. And this is a real cool way of implementing HIPAA compliant solutions, because in this kind of networks, no one knows who are you exactly. So you can easily separate personal patient data from like his medical records. Financial services benefit from streamlined cross-border payments and trade settlements. Also, you cannot really implement general ledger without distributed ledger technology if you'd like to provide simultaneous access to your system. Voting systems gain transparency and integrity from blockchain or distributed ledger systems. So blockchain impact extends to energy trading, intellectual property protection, charity accountability, logistics, gaming, government records, offering decentralization. So a lot of different ways how we can use blockchains and distributed systems, and several unique usages where you cannot avoid using such kind of systems. Let's look at several of those use cases. If you're talking about cross-border payments, this is the most common use of the blockchain, and it's popularized using Bitcoin as a payment method. So cryptocurrency is the most typical way how you can do cross-border payment, easier, faster, and cheaper than you are sending fiat currency to like cross-border. This use offers the potential for blockchain to be used to efficiently process cross-border payments. Currently, cross-border payments involve a long and costly process and require a variety of different intermediaries. This process can increase costs by around 10%. It can take from 3 to 5 days, and it would not be finalized until funds are received. With blockchain, the payment could happen in real time without intermediaries, therefore at a much lower cost. So in this case, we have Alpha and Beta corporations that has B2C accounts in Alpha and Beta Bank, and after that they have B2B accounts in Alpha and Beta Bank correspondents, and they're using Sigma system for sending money from country A to country B. And of those intermediaries are charging their fee, and it takes time for each intermediary to process the transaction. So in this case, we have 5 intermediaries that are sending the money, let's say each of them using 1 day for processing and 2% per transaction. So at the end of the day, you have minus 10% of amount that you have sent, and you have spent 5 days for those transactions. Another way of doing that is not using traditional ways when you have 2 bank accounts and you have a system which is processing that cross-border payment for you, but you can use distributed ledger, and you can use passive account holder into different countries where using them, you can send money cross-border without any interruptions and without any problems with accounting and money tracking and transaction tracking itself. Another case of, give me a sec. Okay. Another use case of Sorry. Another use case of blockchains and distributed systems in general is digital identification. So a very good example of digitalized identification is Estonian e-government, where they have implemented fully electronical government and electronical digital identification based on the blockchain, where you as a person, you can receive digital identity in there, and you can use it for digital voting, education, employment, healthcare. You can make almost everything that you can do with your. You can do basically everything that you can do with your normal document, with your normal passport. You can use it as an electronic copy, and you don't need really physically present in anywhere to use your document and to get government access to government tools. Oh, talking about smart contracts, blockchain and distributed ledger can also be used in the operation of smart contracts, which are a series of automatic processes that are executed upon certain specified conditions. So they are not like legal contracts when you need to sign by two parties and you can interrupt this process and it can be painful, but rather a specified state or set of procedures that will be followed when certain conditions occur. So you have a trigger for, in smart contracts, you can code a trigger when it happens, something will happen after that. So think of smart contracts as if something happens, then something happens, or something would be created, statement written in computer code. If certain conditions are fulfilled, then a certain process will occur. They are powered by the code that creates a block. So smart contract itself is located inside of the block as a data. Once a certain set of obligations has been fulfilled and detected by the code, a transaction is triggered. So this could help to revolutionize dividend payments to shareholders that can be used, like in these cases, that can be used in selling property, selling almost everything, and it's secure and guaranteed way of processing the transaction. Another way of using blockchains is blockchain bonds. So a digital asset is a liquid digital presentation of a traditional asset. So you can tokenize or digitalize almost everything. So and by doing that, you're creating a unique item and you're recording your ownership of this item. So process of transforming something into the token, which is located into the network, known as tokenization. When a traditional asset is tokenized, it becomes easier to trade and may be bought in smaller fractions. So talking about bonds, they're usually the big chunks, which is not so easily can be sold to B2C customers. So, but when you're tokenizing those bonds, you can split them into the parts and you can sell them to the B2C customers in a smaller chunks, in a smaller amount. Instead of physical certificates, blockchain bonds are issued as tokens that are registered on a given blockchain network, and investor would pay for the token's ownership using traditional fiat currency. So using smart contract, you can guarantee that process. So usually if you're talking about blockchain bonds or any kind of transactions, including purchasing something, smart contracts are taking place in those networks as well. Non-fungible tokens. One of example of digital token that is quickly rising in popularity is NFT, non-fungible token. A non-fungible token can tokenize nearly any form of media: a drawing, music clip, video recording, newspaper article, poem, everything. Uh, they're similar to collectibles such as baseball cards or Pokemon cards. Artists can upload their creations to the blockchain to sell, to receive payments from an original sale and secondary sales for a fee. And this is implemented by a smart contract on the blockchain as well. Buyers can purchase an NFT for a flat fee or at an auction for basic user rights, depends on the platform that is implementing that blockchain. Yeah. And a little bit about the fintech core today. So we're educating and we're trying to talk about fintechs because we're actively promoting our own product, which is called Fintech Core. It's a white label cloud solution for launch of fintech products. The main category for this project is the source-based licensing, which means we are providing the source code and you are able to integrate with vendors who have the pre-integrated plugins from our site for the different processes as onboarding, KYC, balance orchestration, banking account orchestration, CAS orchestration as well. Which means you can run the full-fledged digital bank with that, and a lot of traditional functionality like cross-border deposits, credits, notifications, and back office, which is required definitely. Also, we have multi-regional and multi-language support, which makes the solution pretty great if you are starting from scratch and you would like to focus more on the business strategy rather than the tech, which usually is really heavily in part of the business. And why we are promoting this product in terms of this webinar, because it's built using like general ledger system of this product is built using distributed ledger system. And let's look at the example of usage of the system. So as a, let's assume that we have a bank that, who is implemented on the fintech call. Let's name it the bank A. Clients have an account in this bank. And he has two cards to his bank account, one for himself and one for his wife. And he's taking the card from his bank account and going to shopping. And he's providing another card to his wife and saying, okay, you can go and buy that pretty dress from another shop. And at the moment when they're shopping at the same time, when they're paying at the same time at two different places, what usually happens in traditional banks or non-distributed ledger systems, you basically cannot do that. So first transaction is processed, but the second transaction is pending until the first transaction is processed. And in case of any machine failure, one of those two transactions can be not charged from the balance. And that is a problem because you as a bank owner need to pay for that mistake because you have not charged your customer, but you has been charged by an institution that has been charging you. So using distributed ledger system, it cannot be happened because we have a record of all transactions and they are in consensus in the system. So we are not locking transactions. Both of them, like the man and the woman, can pay with cards from the single bank account. And at the same time, both transactions would validate balance, would validate account state, and would have the same account state at the same time. Okay, thank you for your time. I think I've covered some things about blockchain and distributed ledger system today. And now you have an ability to do the questions. Okay, so I can see no questions in the chat. I will give you like another 30 seconds. In case if you have some questions, please let me know and ask them. Otherwise, you can contact me by email. You can like type me to LinkedIn, or you can book a call and we can discuss the specific use cases for your business, or like the better way of implementation of that or another system for your business. Okay, thank you guys for the joining, and I will be glad to see you next time on the next webinar.